A correction back to the 200-day moving, oh, sorry, the 200-day moving average would be roughly about 10%-ish, 10, 11%. So that's not going to be, that's, a lot of people are going to be calling us like, Mike, Adam, is this the big one, right? Are we talking about? But can you imagine just if we go back to the April lows, just where we were in lows of April, that's 26% lower just to retest the lows of April, right?
And talk about that for a second, because a test of the April lows isn't
Mhm.
isn't something completely out of the question here, right?
No, not
Technically.
at all.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here at the end of the week for another weekly market recap featuring my good friend, the languid portfolio manager, Lance Roberts. Lance, how you doing?
I'm doing good. Yes, I'm languishing this week. So,
Well, I picked languid because it means a slow or slowing down. This relates to a piece that you just wrote about some of the leading indicators suggesting that things are slowing down. We'll get to that in just a minute. I got to admit, Lance, I was a little nervous to poke fun at you today with that word because as you were setting up your camera today before we turned on the recording, I got to see your man cave a little bit, and there were some katana swords there. And for those of you who don't know what a katana is, it's one of those Japanese sort of samurai swords. And I
yeah.
asked Lance about it, and he's like, "Yeah, that's back from when I used to fight with swords during your MMA days."
Back in the day, yes. Yes.
Back in the day, so I think I said to you then, I was like, Lance, I always knew you were a guy, didn't want to get angry at me, but I keep learning how bad of a guy you would be to get angry at me.
Yeah, no, those were all the fun days. When you think back to your younger days of stuff you did, I'm surprised I'm still alive today. So, you know.
I'm surprised you've got all your fingers and appendages if you're
Oh no,
fighting.
I trust me, I have battle scars all over my body. So trust me, I have scars galore. So yeah.
Oh my God. All right. Well, look, yeah, I had no idea how much I was taking my life into my hands poking fun at you all these
No, see, I'm
past.
old now, so it doesn't matter. I just, these days I just go, yeah, whatever.
Okay, we'll see. Something tells me the bear still had a little bit of fight left in him, but hopefully I never find it. All right. Well, look, fair amount to talk about this
Yep.
week. Real quick, let me just remind folks that the Thoughtful Money Fall Online Conference is coming up real fast. It's going to be Saturday, October 18th. We're now here at the end of September, so we're getting real close. It's going to be a fantastic event again this year, folks. Extremely timely, especially as things are looking so uncertain for 2026. Also, too, I'll break the news here. We've got a few more people added to the roster. Just added Danielle DiMartino Booth, and what was funny about that is I've asked Danielle to speak, I think, at like every conference that we've had, and I thought I was doing her a kindness by giving her a conference off. And I got this angry text from her saying, "You're having a conference and I'm not involved." So she very much still wanted to come in front of the Thoughtful Money audience, folks. And I said, "Of course, yeah. If you want to come present here, we would absolutely love to have it." So we're going to have Danielle. David Hay is going to come. He's going to talk about income investing and investing in opportunities outside of the U.S. We're going to have Craig Wishner on. He's, I think, participated in one or two conferences in the past. He's going to talk about farmland investing. And then, of course, we've got the roster I've mentioned, Lacey Hunt, Judy Shelton, Stephanie Pomboy, Grant Williams, Michael Howell, Darius Dale, Sven Henrik, Andy Scheckman talking about precious metals, Lynn Alden talking about Bitcoin, Melody Wright talking about the housing market. It's going to be just fantastic. So if you haven't bought your ticket yet, really go do it like right now so that you lock in our early bird price discount while it's still there in its last few days. To do that, just go to thoughtfulmoney.com/conference. And recall that if you are a premium subscriber to our Substack, check your email. I've been sending you emails with a discount code that you can use to get an additional $50 off of the ticket price. And that includes $50 less than that early bird discount. All right, Lance, so Slowdown. So you wrote a piece this week titled Slowdown Signals. Are the leading indicators flashing red? So why don't you answer that question for folks here?
Well, this is, kind of just the ongoing debate that goes on, right? Recession, no recession, recession, no recession. And, right now, there's certainly no sign of recession to speak in terms of, if you take a look at economic growth in the second quarter, just printed 3.8% for the final revision. Again, you have to take that with a big grain of salt, because
Right.
a lot of that 3.8% was simply a function of the um, trade balances going back and forth. In the first quarter, we had that negative GDP print because of inventory stocking prior to the onset of tariffs. Then, as soon as tariffs weren't what everybody thought they were going to be, then we had the big reversal of that. So, a vast majority of that 3.8% growth is a one-time effect. But again, it doesn't really change the fact that we're seeing a lot of economic weakness across various sectors of the economy, whether it's manufacturing, services are showing a slowdown, labor costs are declining towards 1%. We just saw it today, personal income and spending coming in terms of the latest reports. Personal income came in at 0.4%, which was just slightly above expectations of 0.3. So that's good news, but personal spending was 0.6. So in other words, people are diving more into savings, more into debt, et cetera, because their incomes aren't keeping up with their spending rate. So that's going to lead to again, we talk about these things that are kind of forward projecting, these forward kind of looks. And when you start having a decline in savings rates, then that's kind of a good precursor for a slowing economic environment. And so it's really kind of the jux of the article day. I posted on our Substack page, as well as on Twitter this morning, on X, whatever. But the big driver for this is really this expectation for forward earnings growth. And that continues to be my biggest concern here. Let me share this chart with you.
Yeah, and as you're pulling it up, the reason why you care so much about it is because, as you always tell us, it's really future earnings are going to dictate where asset prices go.
Exactly. It's a very, very high correlation between the two. And again, and it's also just how investors operate. They're looking forward. They're saying, well, I can afford to pay 24 times earnings today on a forward operating basis because earnings will catch up with me. But look at this chart for a second. So this is the gap between the Mag 7 stocks and the bottom 493 in earnings growth.
Okay. Hey,
So
can you just magnify that a little bit?
Sure, absolutely.
Trying to be sensitive of our folks who we're readers.
Yeah. Like me.
Like you.
Is that better?
Yeah.
Okay. So the blue lines are the Mag 7 earnings growth. And you'll see first quarter of 2024, you had 50% earnings growth. That's been declining, obviously, just as these companies are getting larger and we're kind of going through the cycle. But you'll notice that earnings growth for the bottom 493 has really been non-existent in 2024 and 2025. Even in third quarter, fourth quarter this year, they're only expecting 4% growth in earnings for these two stocks. Now, if you take a look at the economic data, that's where earnings come from. If you have strong earnings growth, then that's coming from strong economic activity. And so Wall Street's expecting this big surge of 11 to 15% in earnings growth for the bottom 493 stocks. Now, this is far worse once you get to small and mid-cap stocks, because 40% unprofitable, they've got debt problems, all other kinds of things that are highly sensitive to economic data. Their growth rate's expected to be flat to negative. But the point is that Wall Street's expecting this really strong economic growth going into next year. The question that we have to ask ourselves as investors is, okay, fine, where's that going to come from? And particularly given the case, if earnings growth is slowing for the Mag 7, which are your big revenue drivers, then how is it that this other 493 companies are going to magically manufacture earnings growth when the Mag 7, the biggest drivers of revenue and earnings over the last 5 years in particular, is losing ground? And so so the point is, for investors, it's something to pay. I'm not saying that it can't happen. So don't say that this is absolutely what's going to happen, because it could, who knows? But it's just something to certainly be cautious on, and particularly.
And what's the narrative there? Is it that AI is finally going to start delivering results to the smaller companies outside of the Mag 7, or is it something else?
Well, that could be part of that narrative. But again, if AI is going to generate stronger economic growth, where does economic growth come from? It comes from demand within the economy, right? So I've got to have more full-time jobs, people collecting paychecks. I got to have rising wages, all those type of things. And AI does the opposite of that. It reduces jobs, it lowers wage growth because it increases productivity rates. So that certainly doesn't augur well for stronger economic growth to support estimated earnings for companies that have not actually posted earnings growth of any sort really over the last couple of years. And this is the leading economic index, which continues to be negative and has recently turned lower. So again, despite what we saw in Q1 and Q2 in terms of GDP, even in Q3 of GDP, right now, Q3 GDP is expected to be about 2.2% growth. Leading economic indicators have turned lower again. So that certainly doesn't suggest that we're about to have this really robust economic growth within the overall economy. And
yeah. Hey, sorry, real quick on that on that chart.
yep.
First off, leading economic index, that's a composite of a whole bunch of different indicators, right?
Leading economic indicator, credit, markets, all kinds of stuff. Yeah.
Yeah. Okay. Yep. So it's a hodgepodge of many different things.
Right.
I just want to note here, kind of every time it has dipped negative, we've had a recession, with the kind of notable exception of 2022. Although I will say that wasn't a fun year.
Yeah.
So I guess you kind of got to ask yourself if it is indeed declining again here in negative territory. Something different has to happen this time for it not to be at least an unhappy year.
I wouldn't say that something different needs to happen, because if you look, so first of all, leading economic indicators. So two things real quick. First, this is the 6-month rate of change. So if you just take a look at the leading economic index, it just kind of goes in a 45-degree angle and kind of bobs up and down. So looking at it on a 6-month rate of change gives you a much better indicator of economic impact. And historically, going back through history, excuse me, a negative downturn of consequence in leading economic indicators has always been in conjunction with a recession. So to your point, though, 2022, we did not have a recession, even though it wasn't a fun year. And the difference was between 2022 and every other recession period was that we had this massive influx of capital in the markets, zero interest rates, quantitative easing, just all these stimulus checks to households. And we built up that huge, big wad of economic activity that is still kind of working itself through. And so we've now gotten to the end of that. And so the issue now is the leading economic indicator going to start registering? And again, I don't know the answer to this, but given the historical function of how the leading economic indicators work relative to the economy, with no more stimulus and all this other stuff supporting economic activity, and we're starting to see investors, capital run out of the economy, lower employment growth, those type of things, are the leading economic indicators about to start going back to functioning properly? In other words, in 2022, they didn't function properly because of these one-time anomalous impacts on the economy. Now the economy is returning back to normal, which means that the indicators should start to return back to normal. We'll see. And again, I'm not making a prediction that, we're about to have a recession, but what this does suggest is that the economy is slowing down. It's not accelerating, which does put forward expectations at risk. And when you look at CAPE at 40 times earnings right now, you've got to pay attention to what's happening with the economic growth rate.
So totally great. And I think you're making my argument for me, which is we actually had an explanation in 2022 that there was something different this time, that this might not be commensurate with a full recession. And your answer there was we had all this stuff still sloshing around from the COVID rescue efforts.
Right.
Now that we don't, you got to have another explanation to say, all right, well, if this continues to drop further into negative territory, we're not going to have a recession because of special case X. That's really all I'm saying. Yeah.
And you're right. And that is correct. In other words, you need something that's different this time versus previously when these economic indicators work. And that's the same thing with the yield curve. And a lot of people are like, oh, the yield curve inverted, we're gonna have a recession. No, the inversion of the yield curve is not the recession signal, it's the uninversion. And so we've had an uninversion of the yield curve that typically precedes slower economic environments. There's a lot of reasons for this economically, but uninversions of yield curves are typically where you start seeing slower economic growth. And remember, we might be in a recession early next year, but won't know it for a year, right? Until it shows up in the gray bar after it gets dated, right? So, the kind of the key to all of this is paying attention to these indicators and what it suggests. And as I was just saying a second ago, this is the percentage of total employees. So you take a look at all employees, that are employed, right? This is not the working age population. So are you employed? Yes or no? Okay. How many of you are working full time? And that rate is dropping. And you only see that in slower economic environments. And there's a decently high correlation to economic growth versus, the employment levels. And it makes sense. Again, if I have a full-time job, I have benefits, I have healthcare insurance, I can take care of my family, I've got some discretionary income. If I'm working 3 or 4 part-time jobs, I probably don't have a lot of excess discretionary income to support the economy, right? So I think that's the thing this is one of the things that I pay the most attention to, is continuing to watch what's happening in employment because of its impact. Consumer sentiment is also very important, and that's clearly not going in the right direction. So, we had this big surge in consumer sentiment, during all that kind of COVID stimulus and things like that. But that's all starting to work itself out. Consumers are becoming a lot less confident, both on current conditions and forward expectations as well.
Can I ask you a really high level question here?
Sure.
So it's a little easier to see in some of the other charts, but I think we can see it here.
I can go back to a different chart if you want.
No, it's fine. So the last pronounced recession that we were in was the Great Recession, right?
Right.
Which was 2008 through, I think, spring of 2009 officially.
Yeah.
Yes, we did have a recession during COVID, but it was literally a blink and you miss it recession. You can almost not see the gray line here.
Right.
Right. So
that's a recession in history.
Yeah. So kind of for all intents and purposes, we haven't had a recession now for what, 16 years?
Yeah,
Right?
effectively, yes. Well,
Yeah.
again, if you don't count the pandemic, which is kind of an oddball thing because it wasn't a natural recession, it was a man-made one.
Yeah, well, and yeah, exactly, because we shut the global economy down, right? So let's put an asterisk on that and just remove it from the data set for a second. I mean, that's kind of, I'm going to say anomalous, but obviously we only go back, this chart only goes back to the 50s.
Only the
But I
50s.
think, pardon me?
Only the 50s.
Only the 50s. But I think if we went back, another 100 years or so, we would have had recessions a lot more frequently than 16. Like 16 years is a really anomalous time, right? And my thesis here, you tell me if you disagree. I don't think it's because the economy just magically, became more resilient. I think it's more from a policy standpoint that
absolutely.
we got a lot more allergic to the concept of having a recession, right? And I suspect that that's the playbook that's in place. So which is one of the points I want to make here is just kind of crazy, right? And I've used this analogy before. It's just like saying you don't like winter and you don't ever want there to be winter. And so when it gets cold, the government's going to spend a ton of money and bring a bunch of heaters outside, and we're going to, try to just heat away winter, right? And, as we've talked a lot about, look, winter plays an important role in the seasons of life, and recessions play an important role in capitalism. They're there to get out the malinvestment, right? Creative destruction. So I guess, so the next question here is what does your gut tell you? And I know I'm just asking you to totally guess here, but if we start entering recession again, is it going to be all guns blazing? Like, okay, we got to do everything possible to make this recession last even shorter than the COVID one. Or do you think it would be more pronounced this time?
Well, it depends on the cause, right? So again, we talk about this a lot and written about it a lot. If you're having just a normal economic slowdown that slips into a recession, right? Nothing earth-shattering going on. It's just consumers are running out of capital. Companies are starting to lay off employees to kind of work against, slowing demand, those type of things. And so you just kind of get a more organic recession, kind of like we saw back in the 50s and 60s. It's just kind of these organic recessions that occur. Then, it's not going to be dramatic. Maybe you have -1.5% growth. The market goes down 20, 30, 35%, something like that. You go through a period of kind of adjustment. The Fed will cut rates to zero, probably restart QE at some point. And, that it won't be this devastating event, right? The problem that we have right now is for most investors is there's only been 3 recessions that most people remember now because of just we're getting older. Most people don't remember the 91 recession, which was mild. It was an organic recession. You have to go back to really the late 70s, 80s to get, bigger recessions that were normal, right? Just kind of a normal recession. So the only recessions that people know today and the only ones they remember is the dot-com crash, the financial crisis, the pandemic shutdown.
Yeah,
That's
and
it.
sadly, in terms of like professionals, a lot
That's
of
all they
them,
remember
a
too.
lot of them don't even remember the dot-com crash anymore. I
Exactly.
mean,
Well, no, exactly right.
talk to a 40-year-old, they don't remember it very much.
Absolutely. Yeah, no, that's absolutely right. But that's also the dangerous problem here. And again, this is why, I push back on narratives a lot of times with people is like, oh, we're about to have a 50% plunge in the market. Yes, it's possible. It is entirely possible we could have a 50% decline in the market, but you need an event to make that occur. And that event is going to have to be credit related at some point. And there's certainly some things that are popping up. We're starting to see some issues in the credit market.
Yeah.
Not
I'm going to
anything
ask you
major
about
just
I'm going to
yet.
ask you about Tricolor in a second. So yeah.
Right. I was just about to mention that. So you got Tricolor going on, but while that's an important deal, it's not the size of like the subprime prices.
Right.
So
It's not a Lehman. Yeah.
correct. So, so the point is that we've got to be careful extrapolating the word recession to meaning a financial crisis of some sort, because a normal economic recession, which should occur, should be allowed to occur, should happen on a more frequent basis, in my opinion, to keep the economy healthy and going, because it resets debt levels. It does a lot of things. You allow bankruptcies to happen. You allow companies to go out of business. It's not the end of the world. It's actually healthy. Um, but you need for that, again, we just have this psychological link to every recession. The R word is the next financial crisis, and that's not necessarily the case. So I think we've got to be careful as investors is not to make our investment decisions based on every recession being a financial crisis.
Yeah.
Even could, again, there could be an event. I mean, Tricolor may be, just the needle in the haystack. And like we saw in the dot-com crisis, it was Enron. Sorry, yeah, during the dot-com crisis, it was Enron, and Enron was a fraud, and it was and completely kind of blew up. But then we started figuring out it wasn't just Enron; it was WorldCom, it was Lucent, it was Global Crossing, it was all these other companies that were involved, and that's what fueled that return to rationalization of what was going on during the dot-com crisis. So, again, Tricolor could be that. Maybe there's a whole lot more out there. We don't know that yet.
So okay, good answer. I agree with what you said. Let me flip it though from
Sure.
investors to the folks that are running the economy, right? Our politicians, essentially, right? I think they have gotten to the point where in their mind, recession is it's an intolerable thing. I guess this is
Right.
kind of my question, where I don't think if they would be like, oh, this looks like a garden variety recession, and we're just going to let it play out over the next couple of quarters because that's healthy for the economy. I think they're going to react as all hands on deck.
Mhm.
We can't let this happen. This is terrible. People are starting to lose their jobs.
Yep.
I think we have a president in the Oval Office who loves to use the stock market, as a personal scorecard.
Mhm.
Um, and so, I guess my question to you is, do you suspect that what do you suspect their reaction function would be, even to the beginning of a garden variety recession?
I think it'll be exactly what you just said. I think that, and again, it's not just the current president that uses the stock market as a scorecard. Biden did it. Obama did it.
Oh, sure. I mean, but I
Every
mean, honestly, Trump, he beats
yeah,
that drum. I mean, more than
yeah, yeah,
anyone.
of course.
But
But
yeah.
they all every president does it, and of course you would, right? It's like, hey, our stock market's at record highs. That's great, right? That just shows the economy's healthy. We're booming. It's a good marker. But no, absolutely. After the financial crisis, our policymakers have gotten addicted to what they can manually factor into the economy. The Fed's going to immediately return to QE. They'll immediately, the Jerome Powell, I always kind of laugh. Jerome Powell says, we're not ever going back to zero interest rates. BS. As soon as you get a recession, you'll be at zero interest rates. First sign of if Tricolor shows up as a bigger issue with the credit crisis and starts to impact one of your member banks like Goldman Sachs or JP Morgan, your rates are going to zero. Let's be honest. and, and state the card. But we've gotten used to this. Don't be surprised if we get into another downturn in the economy that regardless of who's president, whether it's President Trump or whoever's the next president, don't be surprised if there aren't immediate calls for checks to households again because they
I
saw
think
what that
I think
did.
there will be. I think that's a
Absolutely.
guarantee. Will we do
I,
it? Who knows? But I feel comfortable sticking my neck
yep.
out and guaranteeing that will happen.
I,
There will
I,
be
and
calls for it from Congress and from the people themselves.
absolutely. And it'll be from the right, it'll be from the left, it'll be from everybody in between because what they saw is that they could stimulate economic growth. And all of a sudden, they could quell that recession. They could make people happy. They could buy the votes that they needed to stay in office. So you've now established that MMT playbook, modern monetary theory playbook, into the policy making decisions coming out of the government. And no, to your point, I do not think that changes. And I think
Okay.
that'll be the first thing we see if this economy does actually start turning out. And if we turn into a mild recession, maybe they don't go extreme. But if there's any sign of a credit problem, particularly with the major banks, immediately they're going to go to that playbook.
Yeah,
That's my opinion only. Of course, you may
yeah,
disagree.
I personally, in two guys' opinions, but I personally think the moment that we start seeing job losses on a monthly basis, more than 1 month in a row, you're going to start getting a freak
False.
out in Congress about this. Yeah.
Yeah.
Okay, so here's why I'm asking all this, right? So there's a price to that, right? Because it
Mhm.
begs the question, well, why didn't we just do this all along, right? If it's easy just to intervene and make a recession not arrive, why don't we do that, right? Nobody likes
Right.
winter. And from my perspective, the cost is, I mean, at the end of the day, it's wealth equality is the cost. It is the purchasing power of the currency is paying the price, and you are at the same time um, making money by less, so everybody gets hit with an increase in cost of living, but generally you're goosing asset prices, and those are owned very in a very concentrated basis in a relatively few households, right?
Right.
So that's been the price that we've been paying. Now, inflation, what's the Gilbraith comment? It was the tax that not one man in a million, could see. Now I think we are a little more attuned to it, given the big jump we've had in cost of living recently. So maybe it's becoming a little bit more of a limiter. But it is interesting. I look back on those charts you just had, and there were a whole bunch of other recessions there.
Yeah.
And they could have decided to do something like this, but they didn't. What do you think kept them from doing it back then? Was it a respect for the purchasing power of the currency? Was it because the currency was tied to something physical and they just couldn't do it because it wasn't a fiat currency? Like, why didn't they take that presumably low-hanging fruit?
Well, so a couple of reasons. One, so first of all, the purchasing power of the currency is just simply a function of inflation, right? So the question you have to ask yourself is, do these policies create inflation? So the only policy that we saw actually create inflation versus deflation was stimulus checks to households, and because we had no, so we've done QE, had no inflation, right? Inflation ran actually below levels. The Fed was begging for inflation, all during 2010,
I'm
2015,
I'm
2020.
resisting the argument that CPI doesn't really reflect people's true cost of living, but go ahead.
Oh no, no. Hey, no, I'll absolutely agree with you that, the CPI, which is the measure of inflation we have to work with, right? It certainly does not reflect everybody's cost of living. For example, people in New York, they pay four times the rent. The rent in New York is four times the rent it is in Texas. So it depends on where you live, right? Same in California.
Right.
So everybody's inflation rate that they personally pay. There was a really great article out on, I think it was on Zero Hedge earlier this week, talking about Gen Zs and millennials are tapping their 401k plans to pay for living expenses
Yeah.
because their cost of living is above what they're bringing in income. We just saw that in the personal income reports today.
Yeah.
Personal incomes are going up 0.4%, personal spending is going up 0.6. So
Point
we're
six, right? Yeah, because you can only use buy now, pay later on so many burritos.
correct, right. So no, absolutely agree with you. But when we're talking about global economic dynamics, we have to focus on CPI, which is our global inflation gauge. That's
Hmm.
that's what everything's tied to. Um, so, the issue is that the only policy that we saw create inflation was stimulus checks, sending checks directly to households, actually physically printing money and sending checks to households. That was your inflation push. So I'm not so sure that we will immediately jump back to that. But previously, we never did that. That was never a consideration previously. The Federal Reserve did not become active in managing the economy until after 2000 during the dot-com crisis. And
Yeah.
that was where Alan Greenspan started promoting, adjustable rate mortgages. We never had a housing problem prior to 2000 because that was when we started doing adjustable rate mortgages. We split up down payments into 80/20 so you could bypass PMI and get out of the 20% down payment. we started doing all these things to manufacture activity in the economy. And then the politicians go, hey, we've never done this before, but this is working. We like this. And so now
Right.
you've ingrained this, but it was never a consideration for the Fed was, previous to really the turn of the century, the Fed was this very quiet organization. Nobody knew who the Fed chairman was. Nobody knew who Fed members was. If you ask anybody in the 90s, like, who are the Fed members? They couldn't even tell you the chairman was,
Yeah,
much
that's
less
right.
board
More people
members,
could
which
tell you FOMC
everybody
members
knows.
now than ever in history. Yeah,
Yeah.
exactly.
Yeah, so the Fed was very quiet. They just basically managed reserves for banks, and there was not this intervention into the economy, and so that just never really occurred. And even deficit spending was not a deal until Ronald Reagan came along, and Ronald Reagan said, "Look, we've got to break the back of inflation, so we're going to hike interest rates. We're going to do this thing to break inflation from the oil embargo in the 70s." And we need to do deficit spending right now to get employment going again. And so they did deficit spending, created 9 million jobs, and got it going. And then the problem is every other president after that goes, hey, if a little deficit spending is good, how about a little bit more?
Right. Well, so
And
we're getting to the heart of my
yeah,
question, which is, so was there a culture or set of values around fiscal restraint
yeah,
that really our leadership held for 200 years
yeah.
and then decided, ah, you know what? Let's loosen it a little. Almost kind of a letting a genie out of the bottle moment. And then as they got a taste of it, they both realized, hey, this is great in the immediate term. And also, I'm beginning to see it create some issues down the road, but I can paper over those for the rest of my tenure and then get
Yep.
out of here and let someone
No,
else deal with it.
absolutely. You go back 200 years how the country was founded, and you kind of look at, each, kind of Congress over time and policies. Again, we used to vote on spending bills one at a time. So if you wanted to do a spending bill for agriculture relief, whatever, you voted on that bill, and then you voted on another bill. And so it's kind of like mission creep that happens. And so you do one thing, and so during World War I, we started voting on bulk bills, and that was supposed to be a temporary thing. And then once the war was over, supposed to go back to just managing, the purse as it was meant to be, done by Congress, voting on one bill at a time. Of course, once you do that, it's like, oh, this is so easy. We'll just do this going forward. And those things kind of lead to each other. And so over time, yes, that very conservative kind of monetary nature of the economy has slowly been whittled away for ease, for expediency, for better outcomes, and these type of
Yeah.
things. And that just has just continued to kind of just layer upon things over time. And it's worked for so long now that this is just the way we do things now. It's like, look,
Well, and
when was
it's also
the
like you can't do things differently without a massive cost,
right,
right?
right. But when was the last time we actually passed a budget in Congress?
Yeah,
You know?
forever ago.
Yeah. It
Because we
was
just use continuing resolutions now, right? Yeah.
correct. The last time we had a budget was when Bush was in office, right?
Which one?
And the second one. So sorry, Bush Jr. But yeah, when Obama took office, that was the last budget we ever had. And during his entire tenure, during Trump's tenure, Biden's tenure, and now, we don't, every time we come up to a debt ceiling, there isn't even a discussion of passing a budget. We just pass a continuing resolution, which then the problem with that is that every continuing resolution takes last year's spending, adds 8% to it, and that's the new budget. So we're just increase. This is why spending continues to double every 8 to 9 years. Rule of 72 is because of these continuing resolutions. We're not actually doing anything to cut spending.
Yeah. All right. Well, look, sorry to go on this aside, folks, but I think it's
No,
really
it's
important just at
important.
a very high level. Yeah. And hearing, us talk about this, to me, it really does feel like the journey of the addict, right? You take something you probably shouldn't take, and it makes you feel great in the immediate term.
Mhm.
But the more you take it, the more the withdrawal period afterwards,
Mhm.
the more pain it has. And then if you want to feel good again, you need more of it to get back up to where you were. And then you eventually end in a point where you're like, I can't not be taking massive doses of this all the time, or else the withdrawal I go through is like,
Yeah.
terrible, almost near
Yeah.
fatal.
But to your point earlier about the wealth gap, I mean, this is household net worth by percentile group. So this is different than equity ownership. This actually includes houses. But you get the same idea that, the big bulk of wealth gains has been for the top 10% of the economy. The 50, the kind of the 50 to 90th percentile has done okay since 2020. We've definitely seen some wealth improvement there. The bottom 50% has had some improvement, but not a lot because they don't participate in the stock market. They've seen their wealth has increased really as a function of real estate increases. In other words, their home values have increased. In the bottom 50%, that's mostly their house. They don't have a lot of investments. The 50 to 90%, they have some investments, mostly their house, but the real wealth creation has been in the top 10%, which is the ones that own about 90% of the stock market.
Yeah. And let me just interrupt to note, because I don't think people
Mhm.
can easily see it. There's actually four groups represented in this
Yeah.
chart.
The
The
bottom
top
50% way
1%,
down there.
yeah, the bottom 50% you can hardly see,
Yeah.
both because the color is an unfortunate choice, but also it's just barely there.
Yeah. Yeah. I actually have multiple, I have versions of this chart. I just haven't updated them yet. This was one that was put out last week by the marketeer, but it's the same thing. But again, this is just, kind of that
Yeah,
problem
sorry,
that
pull that back up again, because I just
sure.
want to make a really important point, because the chart does sort of distort it a bit. Um, so if you take the two top tiers there, right, the top
Mhm.
1% and then the next 9%, so you add them together, it's the top 10%.
Yep.
Do the quick math there. They own, it's net worth, right? They own
Yeah.
what? 75%, almost 80% of
Yeah.
total net worth?
Yep.
Yeah. So when we talk about assets being unfair or unevenly distributed, I mean, it is extremely lopsided and only getting more so.
Yeah. And again, this is because of the choices we've made. Again, monetary easing, zero interest rates. If you have assets, right? If you had wealth to start with and you were investing in the markets, this has been, since the turn of the century, this has been some of the best financial history ever for the
Right.
markets.
Because to kind of the core of my point here,
Mhm.
I mean, you have had the folks running the system doing everything they can to help you.
Yeah,
And sadly, not that many people are in that boat on a relative basis, right?
that's right.
So the whole
Unfortunately.
power structure has been supporting essentially the top 10% or top 30% or whatever you want to say
Yeah.
there, right?
And that's why I'm so adamant about getting people to save and invest money. It's easy to sit around and complain about, well, they have all the money, go kill. It's very interesting. I just saw a survey that was out 2 days ago, and they went and interviewed a bunch of kids. 46% of the kids said that socialism is a better system than capitalism.
I have that here to talk about with you. Yeah.
Okay, so I can't remember the exact numbers. So yeah, thanks for having the exact numbers. But it's an overwhelming amount of these young kids say, "Oh, socialism would be a much better system." I have lived in socialist countries. It's not. But even if you look at just socialism as the way it operates structurally, it create wealth. And the whole reason that young people are rebelling against capitalism is because they feel they're being ostracized by the system. Oh, the wealthy have all the capital. I don't have anything. So we need a different system to take the capital from the wealthy and give it to me. Socialism doesn't work that way in reality, but it sounds nice in a thesis. But capitalism is where, if you want to have the opportunity to build wealth, capitalism is what you want. You just have to learn to participate with it. And unfortunately, this is why, when we have our conversations and our rants and those type of things, I always get a lot of, hate emails and comments. It's like, oh, you don't understand. It's like, yeah, I do understand. I've been where you are. I was young once, and I took the steps necessary to participate in the capitalist system. You can too. You just have to want to do it. And it's easy to point fingers and want these other things to be given to you. But anything that's given to you always has a bigger cost than what you go out and earn for. And
Yeah.
it's unfortunate when you look at these statistics. So yeah, 90% of the people, have all these assets. Look, there's a lot of young people right now that are making a ton of money in the markets. Now they're probably going to lose it all in the next downturn because they're speculating on wild, crazy assets. I wrote a piece this week for a daily commentary talking about perps, which are these perpetual options. So you can buy a perpetual option on Bitcoin, and as long as Bitcoin goes up, you can leverage yourself up to 10 times. So that's great, right? So if you have a perpetual option on Bitcoin for $500 and it goes up 10%, you make $5,000. The problem is at some point it goes down 10% and you're completely wiped out. And that's going to happen to a lot of these young kids that are speculating in the market. So, it's important. This is why we talk so much about risk management. It's boring. I get it. Selling stuff when it's overvalued doesn't make any sense because it's just still going up. And why not just be invest these assets that are just going up? I get it. The problem is these always end. And if you're not paying attention to your risk and managing your portfolio and managing your investments the right way, you wind up losing it all. And this happened. We saw this in 2022, just recently. Everybody's forgotten about 2022, but all these young people that had the tiger by the tail lost 90% of their values.
Yeah. Well, I mean, to a certain extent, they still came out ahead because everything's back up to all-time highs, and that's because of all the intervention that's going on. And so a big question is when, if ever, will that break? Which we can continue to opine on. But hey, let me get back to something you said here. So, so first off, I just want to acknowledge that, look, there's always going to be wealth disparity. There just are. Humans are different. Right? We all start from different places. Some work harder than others. Some are luckier than others, all that type of stuff. But if you just look at the Pareto principle, which is ubiquitous in the universe, in general, you're going to have 20% of the people that have the majority of the wealth, and you're going to have 80% of the people that aren't, and you'll find sort of fractal versions of that the further you go down across the population. So there will always be a natural wealth disparity, but I believe, for all the reasons that we were talking about, Lance, it's not natural right now. It is getting increasingly distorted by these factors we're talking about. And I know we disagree about this. I don't want to get into a big discussion about it today. I do think it is harder today because I think you agree with me. We don't have sort of true capitalism these days. We have sort of corporatism, and we have other things that are putting their thumb on the capitalist scale. Are we a socialist country? No, thankfully. But we don't have the capitalism that I think we all aspire to. And yes, we can spend a lot of time, discussing, ranting about this, being angry about it. But to your point, I'm like, look, yeah, the system isn't quite as fair as it was, but that's all the more reason for you to get going and making sure that you end up on the right side of this line, right? So yeah, there are some, in my opinion, there are some headwinds against you that maybe previous generations recently didn't have to deal with, but that's just more reason for you to, grab your destiny and work hard so that you don't get pushed back by those. You're one of the ones that crosses the right side of that line. And I totally believe with everything you're saying, Lance. So it's just our system is still capitalist enough that anybody who works hard enough for long enough can change their station here. And yeah, you might have to get real creative, like sleeping in your car like you did, or making a lot of the sacrifices that I had to make that I did. So the opportunity is definitely still there. And yeah, but I will say this is something that I have been sort of warning about over the past decade or so, which is the more wealth inequality that you create as a society, the more people that you start to really cause to start giving up on the social contract, the more people are going to turn to alternatives like socialism, because they're going to say, look, I mean, you tell me socialism's bad, I'm going to get screwed with that, but I feel like I'm getting screwed by the current system, so at least I may as well get something by who's ever screwing me, and that guy's promising me more free stuff than you are, right?
Absolutely.
And I think that's exactly kind of where we are right now in this college poll that you just mentioned.
But there's a much bigger cost to the free stuff than there is for having a capitalist system.
Oh, absolutely. But a lot of these kids don't know that.
I understand that. And again, you say you make these statements where it's like, well, it's tougher today than it was. It's always been tough. It's not.
I know.
It's
I know.
not.
And look, let's just say,
no.
Pre-World War II, it was terrible growing up.
Yeah, exactly. I mean, that's what I'm saying is that every generation has their challenges, right? Capitalism has never been easy. And the headwinds are different today than they were previously, but they are the same in terms of the challenges. In other words, things are always, World War II, Vietnam, these type of things that occurred, there's always these challenges. The difference is whether or not you go, I'm going to take advantage of the system, and you start that process, whatever that process is. And you look at TikTok as a good example. how many people have started a business on TikTok? I'm not talking about just being an influencer, right? They're getting paid to do ads and those type of things. It's a job, right? And they're definitely participating in the capitalist system by, being an influencer and having an OnlyFans page or whatever. That's capitalistic, that's capitalism at
Mhm.
work. I don't promote that, but how many people have started a business on TikTok just by, making a cutting board or whatever, and they start selling their products online, hats, t-shirts, whatever it
Yeah.
is.
I don't know. Trump says a lot because that was a big reason of saving TikTok was all the small
Yeah,
businesses on it.
there's
But
there are
honestly, just being transparent, TikTok's a black box to me. I've never used it. I
trust
don't know
me,
anything
this is me
about it.
too,
Yeah.
but me too, but
Well, you use it a little bit. I know you do.
I do use a little bit. I haven't figured it out yet, but there are millions of people that have actually started their businesses on TikTok, and and it's just, and that's my whole point is, look, if you want to start a business, there is absolutely nothing stopping you from
Yeah.
starting a business. If you have a good idea and a good concept, there are people willing to give you money. So in other words, yeah, you've got this wealth gap of people at the top, but you know what you also have? You've got 10% of the people with 90% of the wealth that are willing to invest in your business if you have a good idea.
Yeah. I promise you, let's have a conversation about on the good side of the ways in which, scrappy, proactive folks can change their station here, because I don't
Sure.
want to get mired in it here. I will say on that last part, you're right. I'm a little depressed by that because, again, something I've been saying for a good while is I think the economy is sort of morphing uh, to the state where you kind of only have two main options as an entrepreneur if you're going to
Mhm.
start a business, where you got to go real big at scale, like massive scale, right? Sell widgets for, a very competitive price, small margin, but you've got the beanie baby that everybody wants or whatever, right? And you just sell a gazillion of these things.
Right.
And that's hard because you need a ton of capital and you need to get the fad right, right? Or you got to basically service that top 10%. That's where all the
Mhm.
money is. So it's kind of like why Willie Sutton robbed the banks, right? Well, because that's where the money is, right? And so you
No,
got to kind of,
I'm not sure that's the case. You don't have to service the top 10%. You can service the global economy, right? I mean, look, if I want to start a t-shirt business, right? I can
Mhm.
do that. And I could go talk to somebody and say, I've got this idea for a t-shirt business, whatever it is. And there's people out there with money go, yeah, I'll invest in you. I'm investing in, look, I invest in people all the time. So if you have a really great business idea, you've got a business plan, you've got a background in it, you understand what the hell you're doing, I'm interested. Let me know. Send me the business plan, right? We'll take a look at it. But there's a lot of people out there like that. And whether it's real estate investing, whether it's building multifamily homes, whether it's building houses, there are people that will invest in a good, solid business. So you take
Yeah.
advantage of that capital. Banks will loan you the money. But you can then sell that product to everybody in the country, right? So you've got a huge consumer base. And that's the beautiful thing about the US is that we're a consumption driven society. And that's a huge consumer base to sell into.
Okay, so here's my point on that, and maybe
Yeah,
this is a discussion to have in more depth at a later time, is I agree to a certain extent that is catering to the wealthy because increasingly they're the ones that have the capital. So you got to go, knock on their doors.
sure.
Nothing totally wrong about that, but I think that capital is getting increasingly concentrated, right? And then secondly, you know, think of the local hardware store
Mhm.
versus, Walmart, right?
Mhm.
Where it's just getting harder to create a small business and compete with these massive conglomerates and these, global supply chains and,
In
these
general,
hedge fund roll-ups and stuff like
in
this.
general, yes. I will agree with you in general, yes. But there are people that have found niches to
I'm
build a
totally
business in.
there. Yeah, we can talk about this. I
But
was just
see,
painting with a broad stroke.
right. And that's my art, that's my pushback on you is that your arguments are very broad brush in general. Oh, wealth disparity is causing all these problems. It's not. There are tons of opportunities. You just have to be willing to go find those opportunities and take advantage of them rather than sitting on your duff saying, oh, life is so unfair. Adam showed me this chart of
No,
wealth disparity and I'm never going to be able to participate in that. It's untrue. Adam, you're a good example. You built this whole business. You're selling, you're making a lot of money on this channel by selling a product to people that they want. And people
I,
are,
I just want to be clear.
wait,
You and I are
let me,
saying the
let me
same
finish. Let
thing.
me finish.
I'll let you finish.
People are sending you $8, $10, subscribing to your YouTube channel, whatever. They may not have that money, but they're willing to give it to you for the information they're getting. So you've created a product, you've participated in capitalism. You are the best example I know right now for young people to aspire to and say, if Adam can do it, I can do it. Forget all this other narrative nonsense. It's keeping you in your seat. It's not getting you to grow. And we need to start getting more of our young people to reach out there, start reaching for that ring, start taking those risks. Because if you don't take the risk, you can't achieve success.
It's a
Now
very
go.
it's a very kind thing. I just want to underscore, you and I think, are saying essentially the same thing, which is there is opportunity out there. And I think we both want to encourage people to get there. And remind me after I say this, there's something really nice about some feedback that we've gotten about us in this weekly market recap. Um, I do think so. What I do is I do think things are challenging, and I want to make sure people are eyes wide open about the
Sure.
challenges, and then use that to fuel their, okay, well, I better not wait for this to get handed to me because the system maybe doesn't work the way I initially thought it was going to, and I got to get off my duff and I got to work, more creatively like this because there is
Yeah.
opportunity. And honestly, I think kind of in a world of AI, um, those that embrace this hungry, proactive entrepreneurship, that may actually be a really key successful competitive differentiation going
Yeah.
forward in terms of how where you end up. So, anyways, I think in many ways we think the same way here, Lance.
Yeah.
And again, that's why I said, like, maybe we'll do maybe not a rant, but we'll do a show at some point in the future that's about, like, hey, okay, you're 25 years old. Here's all the things that we think you should do, right, to advance your station if you're still. But one thing
Yeah.
I do want to note is I think it's important to talk about all this stuff because I don't think this is what kids are being told growing up
No.
in our education system. They're stepping out into a
Absolutely.
world. Yeah.
Well, it's not what they're getting from the mainstream media, which is all about, everything is bad. They definitely don't get it in terms of, mentorship from other people. And again, you know how many times I've failed trying to start my business? I mean, nothing is easy. And like we've talked about before, the difference between success and failure is those that are willing to try again after they fail,
Yeah.
because you're going to
Correct.
fail. You're going to start businesses and you're going to fall flat on your ass. You're going to go talk. I cannot tell you how many doors I knocked on trying to raise capital to start my first business and all the hoops. Quick story. I was 22 years old. I wanted to start a no, sorry, a fitness business. I wanted to create like the next Gold's Gym 24-hour fitness type thing. Right.
Yeah.
And
Except with swords.
except with sorts, yes.
Yeah.
So I had this idea for a corporate health and fitness facility, 15,000 square feet, all the equipment, nutrition. We were kind of doing stuff way ahead of the time, nutrition, counseling, all kinds of stuff. And I went to the bank and I said, I need to borrow $1 million. I'm 22 years old. I don't have a job. I just graduated from college.
Mhm.
And the bank goes, yeah, no, we're not
Yeah,
going to give
no.
you $1 million. And I'm like, okay, but I tell you what would it take to get you to loan me the $1 million? See, and this is the difference where most people quit. The bank says no. So you go, okay, well, that's not going to work. So I quit, right? So I kept going back to the banker saying, okay, well, tell me what would I need to have in hand for you to loan me the $1 million? And they go, well, I need you to have some signed contracts for at least $50,000 worth of revenue. I said, no problem. So I went and talked to the leasing company of the building I wanted to lease. It was a big strip center in this town. And I said, I need access to this space. I can't rent it from you right now. I'm working on the financing, and you're not using this facility. And this is like an empty strip center, right? The ceiling tiles are hanging down. There's
Mhm.
concrete floors. Half the windows aren't even installed yet. And I said, I just need to use the space here to pre-sell some memberships to this fitness facility that's going to be here. And surprisingly, they said, okay, yeah, you're not going to hurt us. I set
Mhm.
up a table. I put out signs out front. I said, fitness facility coming soon, listed all the aspects, and I sold $50,000 worth of memberships, pre-sale, money in the bank at the bank. So then I went back to the bank and I said, okay, there's your $50,000. And the banker's, well, you know, not, I can't quite do the $1 million loan yet. I really need to see you have a corporate sponsor. And I was like, fine. So I went out and started talking to the big corporation. I got Dow Chemical to sponsor me. And so Dow Chemical says, yeah, if you ever get this thing up, we'll offer it to all of our employees and they can come work out at your facility. I'm like, awesome, great, sign a contract. They took it back to the bank. Bank says, well, yeah, that's getting pretty close. We're not there yet. You need to have some investors that have some capital. So I'd go out and find me 3 investors. And, so I went and talked to everybody. Everybody's like, no, that's never going to work. That's not going to happen. I got turned down over and over and over again. Finally, I found 3 guys that said, yeah, I'll invest money into the business. So I sold 40% of the business to them for capital, took it to the bank, and the bank finally just said, fine, here's $1 million. You can go build your business.
I'll give
And
you $1
so
million just to get out of my face. Yeah.
it was pretty much the case. I just kept beating them down until they couldn't say no anymore. And that took a year and a half to do all that. And could you do that again today? I don't know. Banks are different. But my point is that we built the facility, it operated, it functioned, it made money, it was fantastic, it was wonderful. But there were so many challenges to get there. Now, how many people do you know would stop at every little failure? That every time I got turned down for something, how many people would normally stop versus keeping going? And that's the difference. And that's what I'm saying about capitalism. Capitalism is not easy. If it was easy, everybody would do it. And that's why people are voting for socialism, because that's the easy way. Just give me free stuff. But there's a huge cost to that. And if you think wealth disparity is bad now, wait till you have socialism. It gets really bad.
Well, it's crazy because none of the people that are saying I prefer socialism to capitalism,
yeah,
actually go live in a socialist country, right?
Exactly.
There is no little Miami in Cuba, right?
Exactly.
We got a little Havana in Florida, but we don't have.
Which is hysterical, because part of that article is like, we want to be like Cuba. Have you ever been to? I've been to Cuba. You don't want to live in Cuba. You think poverty's bad here. Wait till you go to Cuba.
Yeah, I have some friends who just went about 2 months ago, and they came back kind of shell-shocked.
Yeah.
They were like, it was a cool experience, but they were just like, oh my God. Yeah.
Yeah.
Yeah. The
So
poverty
anyway, so the point of this is that, and to your point, Adam, is that I think the message that we have to get across to our younger viewers is that no matter what you want to do, you can do it. Just put together a business plan, have an idea, go for it. And look, you may fail. And every great success in the world has probably been bankrupt at least once or twice.
Oh yeah, nobody ever gets it right the first time.
Exactly. But you just got to keep trying at it. And if it's just wanting to build wealth, start building wealth. Just open up an account, start investing. We just rebalanced our accumulator model yesterday. We swapped out some positions in our accumulator model to lower the threshold. So now you can actually build that model for about $1,500. Start with save up $1,500, go invest in that model, and just start contributing to it every month, right? Yeah. Stick $500 a month in, or $100 a month in, whatever you got. But just start doing that and make that part of your system. And that's how you build wealth. Just start, instead of complaining about the system, start participating in the system and start doing what it takes to get to where you want to be.
Yeah. So like I said, you and I are in agreement about all this. Yeah. One thing I will say to your inspiring story is I actually think, I don't like the reasons why this is the case, but I actually think it's probably substantially easier today to get at capital as a scrappy new entrepreneur. Oh, yeah. And one of the reasons for that is, one, capital is concentrated, right? So you got a lot of rich guys who just have a ton of money. They're trying to figure out what to do with it. They're looking for business opportunity. You're actually helping them by bringing them an idea. And sort of similarly with the banks, especially as we're going back into an easing cycle on rate cuts, that's going to, banks, their job is to lend, so so anyways, it actually be easier for you to follow that type of path that Lance just laid out. Yeah.
No, it is. And today it's interesting right now because, you've got so many hedge funds that are out there, so many private equity firms. And this is one of the things we talked about previously, Adam, is about this push to put private equity into like 401k plans and stuff. Yeah. That's a huge negative. We should not do that. But for younger people, it could actually be a good benefit, because these companies, these private equity companies, are going to be sourcing out every form of capital that they can find to fund deals. And they're going to be needing deals to put into these funds to do that. So if you've got any type of reasonable idea, I mean, I just read a story about a guy who bought an industrial manufacturing company. He had no ties to this company. He just went to a PE company and said, "Hey, if you'll give me the money, I'll go buy this industrial manufacturing plant and start running
Yep.
it." And they gave him the money. And so, it's just we're in that cycle right now where actual getting access to capital is really much easier than it's been in a long time.
Yeah, yeah, and there's there's pros and cons about that. A lot of malinvestment probably gets funded, but again, if you're the scrappy entrepreneur,
Yep,
you can change your station through it, right? Okay,
correct.
so let's move on, but real quick, I did just want to note, I have been getting more often than not recently, Lance, just really nice comments from people, both via email and sometimes in the comments of these YouTube channels, and sometimes in DMs on X, about people who have just said, "Hey, I've really appreciated what I've learned about investing from this channel, and especially from these weekly market recaps with you, Lance." And that really is the best feedback that I can get. I mean, this is a mission-driven business. That is the mission. But I'll tell you, Lance, I mean, some of these people have like taken snapshots of their portfolios and said, I didn't really know much about investing, but I've learned a lot from you. And man, I've had such a great year. And they'll show me their portfolio returns for the year, which are amazing, and I'm so happy for
Yeah,
them. But part of me too is like, oh my God, like you're crushing me.
yeah,
Yeah. So I mean, it's wonderful. It
yeah,
really is such a hopefully, a flywheel of education and insight. And again, as I always say to people, information in and of itself doesn't have any value. The value is in the application of it. And so if anybody is actually applying what they learn on this channel or other channels like this, there are plenty others out there to improve their financial destiny. I think that I couldn't be prouder to be part of that movement.
yeah, absolutely. And I just hope those people that are emailing you, showing you their portfolios, also remember to take profits because this will end eventually, and you don't want to give them all back up again. So again, just risk management. Don't forget the risk management part.
Don't forget that. So that's a good segue to start to talk about Tricolor, but also and the potential sort of systemic risks that we might be seeing out there.
Mm.
But before we get there, let's get to the TA, because we still have a market that, while has stock markets had a couple down days, still trading near all-time highs, and valuations are still quite rich.
Yeah, so a couple of things. One is as I wanted to show you, just take a quick look at our factor analysis. So this is
Mm.
factors, it's the factors in the, I'm sorry, go ahead.
No, I'm just chuckling because everything's starting to migrate up to that upper right quadrant again.
Yeah. Well, so again, what factor analysis is what we look at as factors of the market. So what is a factor? So a factor is like momentum or high dividend or mega cap growth. So kind of these kind of investing themes. That's what a factor is. And so we just looked at these. We kind of keep track of these factors, and we look at them on both an absolute basis. So what is absolute? Absolute is how our equal weight S&P 500 index trading to itself? Is it overbought or oversold relative to itself? And then we look on a relative basis, which is how is it relative to the S&P? So what we're focusing on and what this chart is to the right is this quadrant is both the absolute versus the relative. So is it overbought on both an absolute and a relative basis? So for instance, gold miners, which is at is the most overbought, it's 76% overbought relative on an absolute basis and 75 overbought on a score on a relative score. So it's way up here in the upper right-hand corner. But again, it's not just them. It's ARC disruptive technology. You're going to get a theme here, right? High beta momentum, emerging markets, mega cap growth, momentum, S&P growth. So you'll notice that the things that are most aggressively overbought is all the high beta growth related type structures. And when you get these more massive extremes to one side, you eventually get that reversion. And where's that reversion going to go? It's going to go back to the stuff that's underperforming, like equal weighted, stocks, mid cap growth has been underperforming, is like may see a little bit of pickup there, but you're going to get stuff back to low beta. And that's going to be that defensive rotation in the markets when it occurs. And we're not seeing that just yet. But over the last couple of days, for example, in the small and mid cap space, we saw a lot of these high flyers like Bloom Energy, AEHR Systems, others take very big whacks. I mean, they were down, 10, 12, 15% in a day or two. and they just gotten, but these are the stocks that over the last month and a half have had, they're up 70%, 80% in a month and a half. And so they're just giving back some of those gains. So again, just make sure that, again, this kind of goes back to the premise of just managing portfolios. To your point on the TA, we came down, we tested the 20-day moving average yesterday, bounced off that a little bit this morning. We're going to see if that holds. We're still within this very defined trend channel, holding right at the 20-day moving average. The concern here is we do have money flows declining. So even though we've got this bounce in the market, we have money flows declining. You still have this negative divergence in relative strength, negative divergence in momentum, all suggesting that the markets are getting weaker, not stronger. So you're getting a more narrow concentration of kind of what's driving the markets. And again, nothing wrong with that, but it does suggest that, there's a little bit of risk here. Also this week, next week is end of the quarter rebalancing. So a lot of this action that's going on this week is kind of ahead of that quarter end rebalancing. And then of course we're going to start October. So we're going to start to fire up quarter three earnings here pretty quick. So we'll start getting those reports coming in, but seeing a bit of jockeying in positions, kind of going into next week isn't really surprising. The thing we want to watch is if we take out the 20-day moving average, which has been really key support here, this kind of running trend, then the 50-day moving average is sitting right around 6450-ish, somewhere around there. And then you've got a pretty big gap before you get to any real support, around 6,200, then somewhere around 6,000. So, there's certainly some downside risk if we get a correction going.
It's funny that 6,000 now feels like a painful correction, given that at the start of the year, it felt like a real stretch goal.
Yeah, no. I mean, look, a correction back to the 200-day moving, the 200-day moving average would be roughly about 10%-ish, 10, 11%. So that's not going to be, a lot of people are going to be calling us like, Mike, Adam, is this the big one? Right? Are we talking about? But can you imagine just if we go back to the April lows, just where we were in lows of April, that's 26% lower just to retest the lows of April. Right?
And talk about that for a second, because a test of the April lows isn't something completely out of the question here, right?
No,
technically,
not at all. It's not out of the question at all. And look, if you just look at this on a longer term scale, right? This is the kind of the interesting part is that if we kind of back this up, put this on a bit of a scale, so we can kind of look at this here. Let me take the money flows off here real quick.
Okay. By the way, as you're getting rid of money flows, are you expecting money flows to go down as we enter October just because buybacks start getting turned off?
It wouldn't surprise me to see them tailor off a bit more. I mean, they got very elevated during this recent run, so a reversion won't be surprising at all. I mean, that's just a kind of a function of it.
Yep.
So, but like I said, I want to keep things. If you start to keep things in perspective, this is the market going back to basically 2019. So here's the peak of the market in 2020. Here's that 35% plunge. That looks like a little minor correction now, right?
It so does.
Yeah. This is 35%. This is 19. Right. And this is just because of the law of large numbers that's going on here. Go ahead.
Yeah, and I'm agreeing with you.
Yeah. But so you take about a correction back to the April lows. That's basically nothing more than just this trend line that we've been running now for the last 5 years. So a correction back to trend would be nearly 30%. Now, if you don't think people will be freaking out about it, now that will not be a bear market. Okay. A 26% correction. Everybody's going, oh, you violated 20%. That's a bear market. No, that's not a bear market. You're still within a bullish trend going back to the 2020 lows. And more importantly, all the way back to 2009, actually. You'll still be in a bullish trend. You'll have a 26% correction from here, and you'll still be in a bull market. That's going to be hard for people to wrap their brains around.
Yeah, which is crazy just because almost kind of going back to my conversation about recessions, like, yeah, nobody likes to take a 26% hit, right?
Yep.
But in the course of market history, I mean, it's happened zillions of times.
Correct. This is my point about risk management. And I'm actually just writing an article for next week talking about RSI. And I went back and I looked at a relative strength index going back to 1970. And I just marked out what RSI was doing at before every kind of previous significant, kind of market downturn, whether it was into QE or, Euro crisis, whatever. And there's about a 26-week lag on a weekly basis between registering this. But if you just look at this, so this is when RSI hit a peak back in early 2020. And then, of course, your correction came in February, March of 2020. So again, whenever you look at these peaks, kind of in RSI, you typically get corrective actions more often than not. And it's at least worth, and again, it's at least worth paying attention to, because we're seeing a lot of the same, kind of evidence, in the markets right now, where you've got very elevated, peaks in RSI. The market's not really paying attention to it just yet. But when you get kind of these negative divergences, that's, again, just because you don't get the correction today, this is kind of my point. Everybody goes, oh, well, we're overbought, but the market didn't go down. It eventually will. It may not go all the way down to where you are today, but this is why risk management is really important. Because again, you don't want to wind up in one of these periods. This is one of those lag periods where the market had volatility and eventually you had the big decline that came in April of this year. But again, RSI was warning you had a big negative divergence. And RSI, it was warning you that there were issues coming. And then, of course, a lot of investors got sucked into that during the April decline.
You know, I think there's nothing to this, but there was some chatter the other day as the S&P hit 6666 for the first time
Uh-huh.
that, boy, wouldn't it be ironic if, the bottom of the market post GFC was 666 and then the top turned out to be 6666, right?
Yep. No, I mean,
And there is a little coincidence that's happening at a time where I think you're saying, look, there's a number of indicators here that suggest that a rollover wouldn't be crazy here.
yeah, no, absolutely not.
Hey, Lance, earlier this week, I don't know if you've seen it, but I interviewed Mark Newton, who is Tom Lee's research partner at Fundstrat.
Right.
And, Tom Lee, big bull. Mark, Mark, I think, is a technician's technician, is how he would describe himself. He's a total momentum investor and studies the macro and everything else, but says that's just like seasoning on the steak. I just really look at what the price action is telling me. And, kind of like his confidence is better, the narrower, the less far out you go. But he says, look, at least as of early this week, hey, I think the market could still go a bit higher from here in the immediate term. But he said, my indicators are suggesting that a 5 to 10% correction in October, November, probably quite likely here, more likely than not. He would then see that as a buying opportunity to then buy into an end of the year rally that would probably bring the market to new highs by the end of the year.
Don't disagree.
And I was, as he was saying it, I was like, I bet Lance would probably think that sounds pretty fair. Now he said, I get more nervous, especially if we end the year strong, about half one of 2026. We could have some real high valuations to work off, and then the market may either correct or just grind sideways for a large part of the first half of the year. I don't think that would surprise you. And Mark definitely was saying, look, don't hold me to that. I'll come on in December and give you my 2026 update then, given what the data is telling me. But I thought all of that sounded like I could see Lance, more or less agreeing with that.
Yeah, no, I look, the markets are overbought here. A little short-term correction would not be surprising. There's certainly some things that could lead to a bigger correction in October. I'm not saying that's going to happen, but there's certainly some things sitting out there, disappointing employment report, a variety of things. But yeah, going into the end of the year, look, you've got a lot of hedge funds that are underweight and they're underperformance equities. So they're going to be playing catch up in terms of performance before year-end reporting. Because again, it's called career risk. If they don't, match their index or beat it, they're going to potentially lose assets or their job. Corporate buybacks will be exceptionally strong. Almost 30% of all corporate buybacks are done in the last 3 months of the year. So it's a very big corporate buyback because they want to get those they want to get those done before end of the year.
Yep.
Tax purposes, variety of other reasons. So there's going to be a big push for buybacks into the end of the year. And then, of course, just you've also got your seasonally strong period. A lot of retail momentum in the market is still there. You've got a lot of that, and more importantly, earnings should be good. There's no reason to expect that earnings collapsed in the last month. So earnings report should be good. We've lowered estimates going into the Q3 reporting period, where we'll have a decent beat rate, 75-76% beat rate of earnings, something like that. And that's going to help give support to the AI story and a lot of these other stories. And again, there's no reason to expect earnings fell off a cliff in the last 3 months. Now, fourth quarter and next year, maybe some, and early next year, maybe a different story. But going into the end of the year, there's some decent supports for this market to kind of keep it together.
Okay. All right.
Was
Look,
right.
beginning to get tight on time, so I'm gonna cram a few things in here before we wrap up. So we mentioned Tricolor earlier. I honestly haven't had a lot of time to deconstruct the Tricolor story, so you may know more about it than I, but my understanding is that it was sort of a subprime lender in the auto space, a decent sized company. I don't think the biggest in the world, but large enough to matter. And this was sort of appears to be one of those kind of collapse overnight stories where the company just sort of surprised all of its lenders that, like, hey, you know what, we got overextended and we're kind of imploding here. May not be big enough to damage the system, in the type of way that we saw the credit cascade starting in 2008. But it definitely sort of has the smell of like, whoa, okay, this was not expected. People weren't thinking, okay, that company looks sick and maybe it's going to have some rougher days ahead of it. It kind of seemed to catch the credit industry's eyes of like, okay, whoa, we were not expecting that.
Right. And I don't know why that's the case. Right. They loaned
Because
money.
they were a subprime lender, or
They were loaning money to low income households and to basically illegal immigrants that didn't have a social security number. So, that was a big chunk of their business. And, when you're in that type of market, it's just like buy now, pay later. Everybody's like, oh, it's fine. Are you paying attention to who you're loaning money to and what they're using it for? And everybody's just
right,
assuming that buy now, pay later is like, oh, there's no risk. These are all good. They're all going to pay off.
right.
you know, this isn't surprising, and it wasn't just Tricolor. I mean, this week also, what was this other one? First Brands, that was involved in the manufacturing of parts and highly dependent on debts, also facing bankruptcy. So, we'll see if this spreads. But over the last 5 years, 6 years, 7 years, there's been this move. We had this whole kind of narrative in the U.S. is like, oh, don't worry about if people don't have a social security number, they're in, they need to have debt, they need to have these type of things. Don't worry about, people with low incomes, they need to have access to all this stuff. And, this is very much how we get ourselves in trouble. We've had a credit card crisis on the same thing. We've had the financial crisis based on the same thing, subprime auto mortgage debt, but we get into these and this is just a symptom of too much money in the market chasing too few
Exactly.
assets, right?
Exactly.
And this isn't new. This isn't something, like, oh my gosh, no. And the fact that when you say things like nobody saw it coming, they never see it coming, right?
I know. Well, we've
Which is
talked about it. When the buy now, pay later headlines come, they'll be
yeah,
like, who could have ever seen this
yeah,
coming?
exactly. Nobody ever thought that would happen. But it's too much money chasing too few assets. And when you have that, people just start throwing, and this is what I was saying earlier, Adam, about if you want money, this is really a good time to go get it because people are
Right.
throwing money at everything.
But that's
You
what I
just
told you,
have
like
to
that,
have
and that's why
decent ideas.
I hated that. It creates that opportunity because it is the too much money is coming from too much intervention, right?
Correct. No,
Yes.
correct.
Yeah.
Yeah,
Uh,
absolutely. And
yeah.
and what's amazing is that higher interest rates haven't impeded that. We all thought, look,
Right.
and me included, I all thought that when the Fed hiked rates, that we would have a much bigger economic, kind of
Hey,
crush on our hands.
Mr. Lag effect over here. I mean, I
Yeah,
did
yeah,
too. Yeah.
yeah. And it's actually been quite amazing. I did not really, I knew there was a lot of money in the system. You and I talked about in 2022 why we weren't having a recession because of, the CHIPS Act and the IRA Act and all these other type of stuff,
Yeah.
stimulus
Whole
checks
pig
and
in the
stuff.
python. Yep.
Yeah, yeah, yeah. And, but I had, it's actually been amazing. how stable the environment has been because of all that, and even higher interest rates didn't impact that structure yet.
Now, I
Saying
still
it
have a
won't,
worry. Yeah,
yeah,
you too yet. I still have a worry that it's all going to happen.
yeah.
It's just, yeah. And probably right as everybody has given up, the thought that it could happen, right? Oh, we
Well,
dodged
that's
that
when it
bullet is
happens.
right when it arrives. Yeah,
Yeah, yeah.
exactly.
We
Okay,
need
so
people to be absolutely bullish on the economy and the markets, and that's when you'll be in the prime set, right?
well, so anyways, I don't know if we need to talk more about Tricolor specifically, but it's notable um, to, Stephanie Pomboy always talks about, it's not going to matter until the bodies start floating to the
Mhm.
surface. And that's how credit contagions tend to happen, is it's a party that folks weren't expecting to collapse. And then people begin to realize, oh, you know what? This party was a lender to that party, and all of a sudden that got defaulted, and now that second party is now in trouble, right? And you
Right.
can start to have a cascade. Is Tricolor systemically important enough? Probably not. I don't know enough about it. But it's just a sign that, oh, okay, there's a body or two that's starting to float to the surface, and that obviously raises the question, how many more, right? Maybe none, maybe some big ones. We don't know yet.
Yeah. Well, and again, when you take a look at the Tricolor bankruptcy, they listed their liabilities at about $1 billion. That's not chump change, right? And this is
Yep.
the old story: is like if you owe the bank $1 million, it's your problem. If you owe them $1 billion, it's their problem.
Yeah.
So this is the bank problem, not a Tricolor problem. Um,
What
Go ahead.
Good. I was just going to say, another headline that caught my attention on this, and I don't know if it's not directly related, but it kind of rhymes, is
Mhm.
so back to buy now, pay later. PayPal has created their own version of buy now, pay later. I think it's
Right.
called like Pay in Six or something like that, 6 easy installments, right? And the headline was just very recently they're still running it, but they sold the book of debt from it to another company. And you almost wonder if it's them, kind of getting out while the getting's good, like knowing that, this is going to blow up at some point. How
Yeah.
do we not have it affect us when it does? Let's find some sucker who's willing to buy all that debt, right?
Yeah, exactly. No, I mean that's I was just looking real quick, just a comparative. So you have Tricolor at 1 billion, and the subprime market was 8 trillion. So you know,
Small.
yeah, it's
Yeah,
small, and it doesn't mean that there's not, this isn't just kind of the first cascade to fall. I would be careful about extrapolating this into a much bigger issue right now.
I
Like, oh,
would too.
this is the beginning of the next, major
Yeah.
crash. It's certainly indicative of but it is certainly indicative of a much weaker economy because again, they were making loans, these loans were getting paid, everybody had stimulus checks, blah blah blah, and now you're running out of that. And so
Yeah.
now
And
all this loose lending is going to start catching up as people run out of money, they go into deficit, they can't meet their payment obligations, et cetera.
right. So two things. One, we've talked a lot about this around centered around the student loan repayment
Hmm.
situation, where now because you are forced to pay those loans back, you have no choice. You have to skimp elsewhere. And we've seen delinquencies in auto loans, credit card payments, even mortgages start to jump as a result of that, right? So this could definitely be part of that, probably is to a certain extent. To your point, Lance, if they were really giving loans to a lot of illegal immigrants, I mean, part of it could just be their customer base just skip the border on them, right? And I don't know.
Yeah.
And that's kind of exotic. I mean, that's not necessarily economic related. It has an economic impact on companies that depend on that population, but that could be
Well, no,
it could make
I'm
this a
not.
little bit of a special case.
No, I'm not even. No, I'm not even saying that they're skipping the border, right? I'm not saying that at all. It's just that when you loan money to people that, are low, they're low. I mean, their business was low income families and basically, people without a social security number. That was kind of their business, and they did $1 billion worth of it. They all need cars, but if you don't have a way to go track these people down, it's really hard to collect.
But that's what I'm
Um,
saying. Yeah.
yeah, and so and look, it doesn't mean they skip the border. It just means they, if you're loaning money to low income households and to people, if you don't have a social security number, it's probably going to be hard to get, a very high paying job. I'm just assuming. You're going to be working in a lower income strata. That just increases that risk of default on payments as cost of living
Sure.
goes
No,
up, et cetera. Yeah,
yeah, it's a
and
risk. I was just saying that
yeah,
we know that 2 million, by according to the
yeah,
government, Tom Homan, 2 million folks have already either been deported or self-deported. So I'm
yeah,
assuming that some of their population, tricolors, literally skip the border. And if you know you're leaving the
yeah.
country, you're not going to square your debts. You're just going to be like, all right, I'm not paying that because I'm going home, right?
Yeah. Well, and again, Tricolor's based in Texas, so again, that's where a lot of these deportations are happening as well. So it very well could be a part of the issue. Sure.
Yeah. Yeah. Okay. Let's see here. Want to get your quick thoughts on this. So, because, Lance, you, like me, were around during the dot-com bubble, and you saw a lot of the fishy stuff that was going on back then with vendor financing, right?
Yeah. Yeah.
So there's starting to be some questions raised in the AI space that I think are, I mean, they're valid questions. I don't know if it's, if things are as fraudulent as they were back then, but it definitely seems a little suspicious when you have, some of these lead horses in the AI race, who are, doing phenomenally well, then take, uh, basically inject capital into their customers for their customers to then round trip back to buy their product. And a great recent example of that was Nvidia. Just, I think, put like 100 million or something into, here we go, is Nvidia recycling profits. I know it just recently put it into OpenAI, and then OpenAI
Yeah.
announced it was going to buy a bunch more
Well,
chips.
no, it's even better than that. So OpenAI invested $100 million into Oracle, which invested $100 million into Nvidia, which invested $100 million into OpenAI.
Oh my goodness. So it is the Ouroboros. It's just the snake eating its own tail
Yeah.
here, huh?
So, but if you're interested in more commentary on this, we actually wrote on this today in our daily market commentary on our website. It's also on X, also on Substack at Lance Roberts, so you can find it there. But it was interesting because, again, it was a CNBC headline as well, talking about NVIDIA's investment in OpenAI will be in cash, and most of that cash is going to be used to lease NVIDIA chips. So it's very much a circular trade. Now, there's nothing illegal about it. There's nothing wrong with it, right? So you don't want to immediately equate this to, some type of, like this isn't Enron, right? This is all open and above board, but it is worth considering that in order to buy the chips that OpenAI wants to buy, they need $100 million. So I need to get $100 million to buy the chip, to lease the chips from NVIDIA. So NVIDIA says, okay, here's $100 million and I get a $100 million contract. It's just, are you really making money, or are you just moving chips around the chessboard right now?
Right. It's kind of, to me, this is sort of like with earnings per share, where they just doctor it up by doing share buybacks, and yet
Yeah,
the stock rises because the EPS is going up, right? Even though the
correct.
profits haven't changed at all. Um, these things, the market seems to react to these. Oh, Nvidia's putting money into OpenAI. Well, OpenAI should be worth more. Well, OpenAI is buying more chips from Nvidia. Well, Nvidia
Mhm.
should be worth more, right? Where it's just the same money circulating around, right?
Yeah. No, it is. And again, we're posting astronomical valuations on things like, right. And so XAI, which is Tesla's artificial intelligence kind of platform, they just raised it. They just did a funding round at a $10 billion valuation. I mean, we're slapping, multi-billion dollar valuations on stocks. Again, this is what I was saying earlier, is that there's just so much money chasing assets. If you have a reasonably good idea, there's somebody going to throw money at you because they've got to
Yeah.
get that money deployed. Otherwise, they have to give the money back to their investor groups.
Right. Which again encourages, at the end of the day, malinvestment, right? Which is
Correct.
the risk here, right? And
Absolutely.
somebody brought up to me the other day, Mark Zuckerberg said something like, given the size of the pie we're going after, it's worth it to throw a few hundred billion, at some of these things we're not sure are going to work out,
Mhm.
right? Kind of talking like hundreds of billions of dollars are kind of like loose couch change.
Yeah, yeah,
But
exactly.
here was my reaction to that, which is, I get it. The potential spoils of AI are so tremendous that, yeah, they make hundreds of billions of dollars seem like small change now for, if you win the race. The problem is as I see it, and I could definitely be wrong, I'm no technologist, the AI race to me feels much more like a winner take all race.
Hmm.
Right? So you get a bunch of companies that are trying to build the best AI, smartest AI. One of them is going to succeed, and at some point, everybody's going to gravitate to that because it's the best, right? And
Right.
we see that network effect with it, and all sorts of other things. And so, a lot of the big companies now that are trying to win the race are going to not win it. They're going to lose it. And a lot of the phantom capital or phantom market value they have right now, because folks are betting on them to win, that's going to have to go away as they capitulate and say, you know what, I didn't win this race.
Mhm.
So it's just, I don't think people are really cognizant of the fact that, yeah, a lot of this market value de facto is going to have to go away. Now, maybe it won't go away. Maybe it'll get transferred to the winner and the winner becomes massive. But if you're invested in one of the losers right now, you get a date with destiny at some point in the future on that. There's
Yeah.
also the question too of like, and how big is the pie at the end of the day? Like, I believe it's probably pretty damn big. Is it? But is it? Maybe not. And I'll talk about that in just a second. But it might be like the internet, as we talked about, where it might take a lot longer for the winner to realize the value of winning anyways, right? It might be not for 20 years until it's really, proven out. And so even the winners market valuation may have to take a haircut for a good period of time over time. So we have those uncertainties. And right now, to your point, Lance, everyone's just throwing money at this willy-nilly. Valuations are just, as Chris Irons nicely said, are pornographically overvalued right now.
Yeah.
Yeah. So there's that. And then let me just connect one thing and I'll let you react. Bain just released an analysis this week where they said, look, we're doing our best to size kind of the opportunity set of AI here, I guess in sort of present value terms, I guess. And they were sizing it around a $2 trillion market. And they're like, from our analysis, and we're being as generous as we can kind of see how 1.2 trillion of that is going to manifest over coming years.
Mm-hmm.
But there's this 800 billion gap that we can't come up with a credible reason for that to get realized right now.
Yeah.
And so, if it doesn't, I mean, that's like a 40% freaking haircut in terms of the expected value of AI.
But again, that's exactly what happened in the dot-com crisis.
Right.
Expectations get too far ahead of reality, and then you have to adjust back to reality. The internet was a thing. Everybody thought, just because you had the dot-com crash doesn't mean the internet wasn't real. The internet was real, and companies like Amazon and a lot of others, thrived on the internet and did great. But you had to flush out all that excess, all those overhyped expectations. And that's where we are right now. The expectations are too far above reality. At some point, that'll correct. Now, that doesn't mean tomorrow. That doesn't
Right.
mean next week. It doesn't even mean next year. This could very well, this could be we could be in the 1996. We just had Jerome Powell this week go, hey, stocks are fairly highly valued. 1996, Alan Greenspan goes, hey, we're having irrational exuberance in the market. It was 4 more years before the market blew up. So don't think just because expectations are ahead of reality that the crash comes tomorrow. But at some point, there'll be a reversion of reality to these expectations. It was interesting. David Einhorn um, just wrote a piece talking about this. He said that there's an unprecedented amount of spending on artificial intelligence infrastructure and may destroy vast amounts of capital. He said the numbers being thrown around are so extreme that it's hard to understand them, and there's a reasonable chance that a tremendous amount of capital destruction is going to come through the cycle. And again, that is probably a true statement, but it doesn't mean tomorrow.
Right. It doesn't mean tomorrow. And that's kind of the danger here. And I'll get off this in a second. I used this analogy, I don't know, a year or two ago. When you distort the system, it's like, you know, having people go walk out on the ice. And the longer the ice doesn't crack, like, in a pond, the ice gets thinner and thinner the out you get to the middle. But the more people go out towards the center that the ice doesn't crack, the more confident they get in the ice, right? And they start treating it like it's concrete, like it's just never going to break. And then, of course, if you get to the point where reality intervenes and, the ice breaks, it catches everybody by surprise and they are way too overextended because they were
Mhm.
trusting the ice way too much. And that's a big worry I have here for investors. And look, that's just the way markets work, and market doesn't care about my feelings or beliefs here. But that is a
Exactly.
big worry I have, which is if that manifests, if Einhorn's concerns there manifest in a sharp repricing of the markets, yeah, it's going to be disastrous.
Right.
Right now, maybe the market just trades sideways for a decade, like John Hussman's, valuations said it should on average. And we just grind it out that way, and we just have a lost decade in the market. I mean, that wouldn't be good, but it would probably be better than, you know, people getting zorts the way
Yeah.
the what's good.
But typically, historically, right? You don't have lost decades where
You
there's
don't. They
just
bounce back and forth. Yeah.
they're all over the place, right? You
You,
have
you end
huge
you end up at
rallies.
a lost decade, but you had a lot
Yeah.
of volatility.
Again, so I don't want people to walk away. It's like, oh, they're saying that you're going to make no money over 10 years. That's not true. There'll be a couple of big crashes in there, right? A
Yeah,
couple of big declines, 20%, 30%. Again, like we just talked about a little earlier, just a correction back to the bullish trend is a 26% decline, right? That is completely,
right.
that should be in your deck expecting to happen at some point because that's just what markets do over time.
Right. And again, to underscore your point, and that's just to stay in the bullish trend.
Yeah. 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 If
Not
you
even enter
break
a
the
bear
bullish
market.
trend, we got a whole nother conversation to have at that point.
Yeah. But which is crazy because like we kind of treat bear markets now kind of the way that we did recessions,
Yeah.
right? Where it's like, we need them. In fact, you kind of should cheer to a certain extent because it means that you're going to get really good buying opportunities.
Yeah.
Yeah. All
Exactly.
right. Well, look, we're running out of time, and I know I got to get you out of here soon, Lance. So I just want to say thanks to your partner in crime there, Mike Leibowitz, for coming on and pinch hitting for Stephanie Pomboy this week. He talked about, he presented his latest bullish case for bonds. He thinks that bonds have a pretty good outlook ahead of them for, say, the next 6, 12 months. Anything you want to say above and beyond, what he talked about?
Yeah, no, he's right. Actually, this past Monday, I posted on our website a bullish and bearish case for the markets, and I laid out the bullish case for the markets from here, and I laid out the bearish case for the markets from here. Um, in the bearish case, of course, is where bonds really have their best benefit, of course, and for a whole variety of reasons. But when you talk about high valuations, and this is kind of where we are right now. You talk about valuation. So we're at 22 times forward earnings and 25 times trailing earnings. This is on a 1 year basis. And when you talk about CAPE valuations, which are not good for short term, in the short term, valuations are all a function of just sentiment. So right now, valuations are high because we got a lot of investor sentiment, and that's why valuations are high. Long term, 10 years or more, valuations are all about returns. And at 40 times CAPE, your return structure doesn't look good for stocks. But in the short term, it's very bullish. But when you talk about high valuations, those ultimately are going to revert to some type of reality. And one of the big things we're watching on right now is the difference between the annual percentage change in earnings versus economic growth. Now, why this is important is because economic growth is where earnings come from, as we talked about before. And you'll notice that there's a fairly decent gap right now between earnings and earnings expectations, which are pretty elevated. There's this big gap. Historically, when there's a gap between GDP growth and earnings catch down to GDP, not vice versa. So in that environment, and we actually wrote a piece about that, in that environment, the prospect, when you talk, and of course, this also ties into equity risk premiums, which are running at historically very low levels. So you take a combination of all these events and the prospective equity risk premium, and this is the kind of the key sentence here. The prospective equity risk premium based on expected returns is negative, and the ERP indicator from Shiller data continues to track around 20-year lows. All the warning signs are there, and we need to have paying closer attention to the opportunities in bonds and risk in stocks, with the next logical step for asset allocation being a switch to being underweight stocks and overweight bonds, because in that environment, yields are going to drop fairly sharply, elevating your bond prices. And there's a lot of other support for that, including your economic data, which is all turning low as well, which all suppresses yields. And if you take a look, for instance, at the non-financial corporate data, that price input from non-financial corporates is running at about 1%. And there's a very, very high correlation between CPI and the non-financial corporate business, which suggests that inflation is going to drop closer to 1% over the next year than not.
Mm-hmm. All right. And one
So
bit of data that
to
we,
Mike's, and that's why Mike is right, and why, yes, we are getting a lot more bullish on our bond holdings.
okay. And one of the topics you mentioned it briefly earlier, we won't have time to get into it this week, but is that the more that the deeper we're getting into this year, we are beginning to see that tariffs have not had the inflationary effect that many people feared they would. And you briefly mentioned the PCE,
Yep.
today's PCE prices earlier, but they came in exactly as expected, both sub 3%. Yeah, folks, it's not that inflation isn't still going on to a certain extent, but it's not this kind of runaway spike in inflation or dramatic spike in inflation that many folks feared yet. Now, there might still be some
Sure.
issues from that. I mean, last night, Trump just put big tariffs on heavy trucks and cabinetry and all sorts of things. So we'll see. And this was something that you had said, Lance, that, hey, you don't think tariffs are inflationary in general, and I won't have you make that case again right now, but
Right.
So far that has been playing out.
Right, right. And again, when you take a look at the other big drivers of what's going on in the economy, those are all slowing down. And inflation is a function of economy. And the big point about that is that inflation is also where corporate profit margins come from. And so as inflation, so right now, this 3% sticky inflation we've got right now is good for corporate profit margins. But if that inflation rate starts to edge off and start to align with what's actually happening in the economy over the next year, that's margin compression is going to become a much bigger issue for the stock market.
Yeah. Okay. And obviously margin compression, then,
Mhm.
that affects earnings outlooks and that should bring prices down.
Exactly.
Okay. Two things just to mention, maybe we'll get into them more deeply next time. Precious metals are back on a tear. Silver is an official melt up here at this point, Lance. So since we've been speaking today, basically, silver, which was close to its all-time price high, is now up 3% on the day.
Yep.
I just want to remind folks, it's wonderful if you're a long-suffering precious metals investor. These things don't continue forever. And so to Lance's ongoing thing about, take gains, position
Well,
size, or my advice to even just hedge, think about it.
right. No, and again, in our thematic models, we just did a full rebalance yesterday. So we went through every one of our thematic models on SimpleVisor and we rebalanced those. We did a couple of position changes and some of the growth models and those type of things. But in the all-weather model, which owns a whole variety of precious metals, owns uranium, gold miners, etc. We just went in and rebalanced those back to target, took those gains, kind of rebalanced some of the other holdings in the portfolio as well. But again, just part of that risk management process. Just, we actually did that yesterday.
Okay, so you're sticking to your knitting, eating your own dog food. Um, Question for you, Lance, about
Mhm.
Bitcoin. I've been seeing an increasing number of articles of late talk about how kind of technically Bitcoin's starting to look a little concerning to them. Um, do you have any thoughts that we can get into more depth next week about
Sure.
Bitcoin?
No, no. I mean, look, the what's going on with Bitcoin, and actually, it's just interesting. I two things to say about Bitcoin, and we can definitely get into these more next week.
Keep it tight, only because I got a few more
Yeah,
things to get through, and I know we got to
yeah, yeah.
get you
No,
on
I'll
set.
be really fast here. Just a second here. I want to show you this. I posted this chart this morning. So this is Bitcoin in the blue line, and below that is MicroStrategy, and then the 2 times levered MicroStrategy. And what's important is that the MSTU, the 2 times leveraged MicroStrategy, is back to its April lows. So it's down 45% since April. So two things from this is that this is the understanding of lessons about leverage in markets, particularly with
Mhm.
ETFs and how the option roll occurs and why you should not invest in leveraged ETFs. Bitcoin's not down nearly as much as these two, but people chasing those type of levered returns, it can become problematic in a stable environment. So, Bitcoin's not really going up or down. It's been basically about a 25% gain for the last several months. Everything else is getting crushed because of that time decay of premium. So again, be careful if you're long Bitcoin, particularly leveraged Bitcoin. Now, just from the function of Bitcoin itself, Bitcoin is a highly correlated risk on asset. And one of the things that has been kind of happening as of late is that downturn in Bitcoin that I just kind of showed you over the last couple of weeks has kind of been preceding this downturn in stock. So, again, if that continues to melt down, or I shouldn't say melt down, that's not a correct term. If Bitcoin continues to decline, if we begin to see that kind of risk off move out of Bitcoin, that's going to feed over into other risk assets as well, particularly in the stock market.
Okay. All right. Well, look, to the extent you've got more you want to say about that, let's
Sure.
earmark it for next week.
Yep.
Let me also flag for folks too, the next 2 weeks, Lance and I are going to be recording on Thursdays, just for schedule requirements on both of our ends. So, we'll do our best to give you as much of the market's action, even though we'll be missing a day of it. But hopefully
Yeah,
we'll.
and actually, my wife's next chemotherapy treatment is next Friday, so Mike is going to be with you on Thursday.
Okay, great. All right. So we'll
Yep.
have Leibowitz back even sooner.
Yep.
All right. And trades, Lance, any notable trades this week?
No, just rebalancing right now. So
Rebalancing?
we rebalance. So in all of our thematic here, I'll just kind of show you what this looks like real quick. So in all of our thematic portfolios on SimpleVisor, we have gone through and done a full rebalance as of yesterday. So we went into the AI model, a couple of significant changes that we made. In the crypto model, as an example, we owned two Bitcoin ETFs. We swapped one of those yesterday for an Ethereum ETF. So we now have the iShares Bitcoin ETF Trust and we have the iShares Ethereum Trust. So again, we did make that swap yesterday. In the growth focused equity portfolio, we did add a couple. We did a couple of swaps, mostly just a rebalance in that portfolio. And then in the small and mid cap stocks, we took profits in Bloom Energy, Kratos Defense, AHR Systems, which were up 60-70%. We did take profits in those, and just kind of rebalance those all back to target. So nothing major going on, just a simple process. It's quarter end, doing a little bit of rebalancing. We did do, like I said, we did a couple equity swaps here and there just to kind of balance the portfolio a little bit better. This coming week, we're going to do the core models. So in the core models, we'll do a rebalance probably either, probably in the first 2 or 3 days of next week, we'll do a rebalance in our core models of the equity, the ETF portfolio, and the dividend equity focused portfolio.
Okay. And I remember a couple of weeks ago you were saying that you had a list of
Mhm.
stocks that you were looking, that you were waiting for them to get into a territory where you felt like you'd get better entry points. I
Yep.
don't get the sense that you've hit those entry points yet on those.
We did do a couple yesterday, just kind of small position sizes. Like I bought a little bit of Applied Digital Corporation yesterday in the small and mid cap stock portfolio. It's about half a position of what it's going to be. So I'm hoping it declines more. I'm hoping it gives me another leg down here so I can buy the other half of it. Again, it's hard with some of these stocks to try to wait for the exact opportunity. So just trying to step in and do a little
Yep.
bit of dollar cost averaging into these.
Okay. All right. Well, look, in wrapping up here, Lance, we don't have a ton of time for a rant, and I want to do something positive. So I've got a little quick feel-good message, and I'm sure, given your background, you'll have something to add on to it. So we talk about the importance of compounding in investing, right? The earlier you start, you get that magic of compounding, helping you build wealth over time. Your money starts making money for you. But that also applies to life. So, kind of back to Lance's advice there about how you get started, right? And you just start grinding things out, and yeah, you're going to fail a bunch of times, but you're going to learn, and your learning is going to compound. Some bad things will happen to you, but also some good things will happen to you, and the benefits of those will start to compound over time. So the message here is just that compounding works in real life as well. And as a small example of that, I'm sure I'm going to get some grief for this as being, playing in my ego here, but I'm putting it up here just to prove to folks the point I'm making. So I don't know if you saw, Lance, but I put on X the other day. I've been working with this strength trainer for about 9 months now. I was doing the work myself before. So here is a video of me lifting what is a heavy weight for me on a deadlift. And I note that serious deadlifters will not be impressed by this weight at all, but I think a regular person should, just being honest. But 335 pounds. Here is my deadlift at 335 pounds when I was doing it on my own. And you can see, had to really psych myself up for it. Definitely a shaky start. I had to wear a weight belt to get it off. And when I stood up, I then dropped the weight. I didn't bring it back down to the ground. So lots there that you could criticize about my form. Here is the video of me lifting the same weight just the other day, having been trained now by a good professional trainer. And you'll see here, not only am I lifting the weight a lot more cleanly, a lot more confidently. But the form is much better. You see, I'm doing it for 5 reps here, so I'm lifting the weight a lot more, and I'm also returning the weight to the floor every time, including the last rep here. And why I put that up there is just to show you, the difference there. Yeah, I guess it's a fair amount of time. It's about 9 months or so. But I was 53 in the first one. I'm 54 in the second one. It's really not that much different. And my point is, you apply yourself at something, you keep at it, you'll get better over time. The benefits will compound. And I'll tell you, there are plenty of days, over the past 9 months, Lance, where I totally failed on the workouts. I just couldn't get the weight where I wanted to. There are plenty of days where I just didn't want to get up and go into the gym and work on it, but I did. And just that dedication, having a goal, but really importantly, and this is the second part of the lesson I'm trying to impart here, is the older I get, the more I appreciate paying for the wisdom of experts, right? I was only able to get myself to a certain state on my own. And you saw from that first clip, it was very imperfect. Now that I've been shown how to do it better by a coach, I'm much better at it. It's safer. I'm stronger, all the benefits that come along with it. But I'll tell you, I'm going to go in there in a couple hours. Like when I go in there, I've done a ton of deadlifts for this guy. I've done a ton of squats for him. Still today, every single squat I do, okay, Adam, you're sitting a little bit too forward on that one, or your back needs to be a little bit straighter. Like there are all these micro corrections that the expert is able to pick up on that I would never know on my own. In fact, if I was just on my own, I'd probably be continuing to cement my bad habits. As I like to say, by definition, we're blind to our blind spots. Working with a coach, they've got the expertise to not only see your blind spots, but to know where you need to go, where you might not yourself know how to do that. So I've really found, whether it's in money, whether it's in education, whether it's in fitness, whatever, recruiting a good coach is a total force accelerator on your progress, but also on your timing. You can get way farther, way faster leveraging a good expert than just trying to kind of struggle around and grope in the dark on your own. So I'll hand it to you, but I'm sure as both a finance guy and a fitness guy, you've seen the same thing.
Oh yeah, no, absolutely. It's just interesting you're talking about that. Is like, same for me. So I go to the gym, pretty much every day of some sort. I'm working out almost every day, doing something. And, the hardest days are just, when you're tired, you don't want to go. It's easy to go, oh, I'll just go tomorrow. But you just got to go and do something. And typically, if you just go do something, it's always better than doing nothing. But some of
Right.
my best workouts have been on days I really didn't want to go to the gym.
Absolutely. I was going to say the same thing. Yeah, absolutely. There are a number of times where I've gone, he's like, how you doing today? I'm like, honestly, I hardly got here. I'm not sure I'm going to make it through the workout. And your body just, it's not psyched for it. But halfway
Yeah.
through, sort of something happens. And then all of a sudden
Yeah.
you're posting some of
And
your
look,
best.
and to be honest, I've had days where I go to the gym, not in the mood, and I wasn't in the mood the whole workout, but I just got something done and that was good enough. But yeah, no, I mean, but it's the same thing. Like we were talking about earlier about, participating in the capitalist system. You gotta get up and just get started. Just do something. And if you do something, then you do something else tomorrow, then these little small actions turn into something big later.
Right. And, I mean, it's anything, right? I mean, gardeners know
Yeah.
exactly what I'm talking about, right?
Yeah.
And I think what's really important about it too is not only do you get the direct benefits of that compounding in whatever it is, your deadlift or your tomatoes you're growing or whatever, right? But it builds a mental muscle for this, right? So to your point, Lance, when you're talking about like, hey, you got to pick yourself up from failure and you got to go back to the bank and you got to ask what you're like forcing yourself to build that willpower or pushing yourself to build that willpower in all aspects of your life bleeds into what's going to drive your career success or even your relationship success, right? It's in many ways that mental muscle you're building may be more powerful or more important than all the rest.
That's right. That's right.
Yeah. All right. Well, look, we'll leave it on there. We've had some pretty heavy rants of late, so hopefully that one was a pick me up for folks. A couple quick reminders. First off, if you think that the best way to start your compounding journey to a better future for yourself is to continue to watch Lance Roberts on this channel every week, please let him know that by hitting the like button, then clicking on the subscribe button below, as well as that little bell icon right next to it. Again, don't forget that the Thoughtful Money Online Conference is coming up real fast. So if you haven't yet, go get your ticket at thoughtfulmoney.com/conference. And given the growing uncertainty in the market that Lance and I have talked about here, if you'd like to get some help from a professional advisor in managing your portfolio prudently, taking all that into consideration, if you don't already have a great financial advisor, highly recommend you talk to one of the ones that Thoughtful Money endorses, perhaps even Lance and his team there at RIA. To do that, just fill out the short form at thoughtfulmoney.com, and the firms will be in touch with you right away. Lance, my friend, another great week. Hope all's going well in your life with your family. And I look forward to seeing you when you're back in what, 2 weeks?
Well, yeah, no, I will see. Yeah, I'll be back here. So we're going to record on Thursday for the next 2 weeks. So Mike will be here next week. And then the following Thursday, I'll be back with you.
Okay. All right. Well, look, buddy, have a good time in the interim, and everybody else, thanks so much for watching.